Want to be happier than the average American? Make at least $85,000 per year. There are a variety of jobs that pay that, but how much money do you need invested in order to earn that much money without ever needing to work again? This would mean that you'd have a comfortable income and you'd have the choice of what to do with your days. Want to sleep in a little longer or spend a leisurely day at the park instead of racing to work early in the morning? Having $85,000 per year come in without having to lift a finger would allow you to do that. Let's find out how large of a nest egg you'll need to retire on $85,000 and how anyone can obtain that amount, even if it seems out of reach. My name is Chris and I help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. A study of over 33,000 employed adults in the United States analyzed the relationship between income and happiness. The study found that the turning point for happiness was $85,000 per year. Those who earn less than that have a lower than average happiness level, while those earning more than $85,000 are generally happier people. When you have disposable income, you're able to spend money on items and experiences of your choice instead of spending primarily on necessities. Although retired households spend an average of $3,800 per month, living on an income that size can sometimes require significant sacrifice. This could entail living in a less than desirable property, skipping activities, and having to carefully consider every purchase. Theoretically, those who earn at least $85,000 have fewer money worries and are able to splurge often enough to keep them satisfied. Firstly, you'll need to determine how much of your portfolio you can withdraw annually. You want this amount to be sustainable, leaving little to no chance of running out of money. The Trinity study found that it's safe to withdraw 4% each year from a portfolio composed of stocks and bonds. Although the study was done in 1998, it's a reliable guideline because it takes into account a plethora of market scenarios. Even if you retired when the market was performing poorly, or if the market is flat for a long period of time, this method will still work. In addition, it accounts for annual adjustments for inflation, so you have the same amount of buying power throughout your retirement. Alternatively, a dividend retirement strategy is desirable to some people because they can live off the dividend income generated instead of relying on capital gains. Realistically, a dividend retirement strategy would provide 3 to 5% of your portfolio's value in annual income. In order to receive $85,000 per year in income using the 4% withdrawal rule, you'd need precisely $2,125,000 invested. Most people are shocked when they find out how much money they really need to reach their income goals, and that's understandable. How is a normal person on an average income going to save over $2 million? If you break the numbers down, you'll see that it's easier to attain than it seems at first. When you invest over time, the majority of your portfolio will be the result of compound interest, not money that you personally contributed. You'd be surprised how the growth of your investments will accelerate and snowball. Even for someone who has no money invested, growing a portfolio over $2 million isn't out of reach. If you invest $1,000 per month or $12,000 per year for 30 years, you'd have nearly $2.2 million. This is using an average rate of return of 10%, which is the historical average of the S&P 500. $12,000 per year is a small amount of money to set aside to reach that milestone, and it's doable with a long-term mindset and some dedication. The median household income in the United States is about $62,000. Saving $12,000 of that would be a 19% savings rate, which is pretty reasonable considering various financial experts recommend saving 15 to 20% of your income. For someone serious about reaching their goals, making some sacrifices in order to save an even higher percentage of their income is common. If that's not possible with your current spending, chances are that you need to downsize your lifestyle. If you're beginning to invest and are willing to save more than $12,000 per year, you could reach that point sooner. Beginning with nothing and investing double that amount at $24,000 per year, it would take 23 to 24 years to have about $2.2 million. As you can see, even though the savings amount has doubled, it doesn't mean it will take half as long to reach $2.2 million. This is because compound interest becomes more powerful with time. As a result, the portfolio growth is primarily due to time invested and less due to actual contributions. 30 years might seem like a really long time before you can earn $85,000 per year without working. When you're at the beginning of your career, that seems like an eternity, but it goes by quicker than one might think. The average American retires at age 64, which means they most likely spent way more than 30 years working. If they begin working at age 18, that means 46 years of their life were spent working, aside from any temporary leave. If they spent 4 years at college, that still means they spent 42 years on the job. That's quite a bit longer than 30 years. People who are able to build wealth focus on the long term and don't have the "I'll probably be dead by then" mentality. Waiting 30 years to generate this much income makes it difficult to get excited. However, earning higher returns is also a viable solution that could help you reach that point sooner. Instead of investing in the S&P 500, you can invest your money in a growth index that has a higher overall return. The S&P 500 provides a wide variety of large, blue-chip companies, but many of them don't grow at fast rates, hindering your overall return. A growth fund that's specifically designed to provide higher returns should outperform the market over a long period of time. It's important to note that risk will be higher with growth funds, but over many years, the returns will be higher. That's why it's recommended that investors with a very long time horizon have a portfolio geared more towards growth. Profits that exceed those earned in the stock market can also be found in real estate. There are several reasons that real estate can provide better returns than most people earn in the stock market, but it does require more work. The main reason for these better returns is that the bank will lend you money to purchase real estate because they see it as a stable, tangible asset. This allows you to use leverage to your advantage by using the bank's money. Earning a 10% or higher cash-on-cash return is common with rental property, and that's only one form of income. There is no denying the fact that searching for a property and managing it requires more work than simply clicking some buttons to buy stocks, but the returns can make the extra legwork worth it. Consider that $85,000 is just an average, and how far that money will go depends on a variety of factors. The money won't go nearly as far for someone living in a large city as for someone who lives in an area with a very low cost of living. It's also important to consider your spending habits. Spending money on experiences that align with your values tends to increase happiness, but falling victim to lifestyle creep won't. Living below your means is an important concept that leads to an increase in happiness, as you're essentially learning to be more content where you are. Instead of constantly trying to upgrade your lifestyle and spending as much as your budget will possibly allow, spending less than you earn and having a little breathing room will make you feel less stressed. It's common to think that the richer you are, the happier you'll be, but that's not necessarily true. Knowing that people earning $85,000 or more are generally happier provides an excellent milestone to aim for as you age, and you can rest assured knowing you won't have to pinch every penny. Money doesn't buy happiness, but it certainly helps not having to worry about how the bills are going to get paid.